The QBE Australian Housing Outlook 2016 to 2019 forecasts price movements for both unit and housing markets in capital cities and also in selected regional centres. It examines the fundamental drivers of property prices, including economic factors and supply and demand imbalances. GDP growth accelerated in the past year from 2.2% to 2.9% in 2016, driven predominantly by resource exports and residential construction sectors. However, business and consumer confidence and forecast future spending remains weak, which is expected to cause growth to revert back to about 2.2% by 2019. To maintain growth within the RBA's 2% to 3% range, it is forecast that a further 225 basis points cut to the target cash rate will be required by 2019. The strongest driver of housing demand is population growth. Falling arrivals and increased departures are set to continue, resulting in the forecast net overseas migration from 2017 to 2019 being the lowest for 10 years. Net interstate migration will continue to be strong in Victoria and show a slight improvement in Queensland, Tasmania and the ACT. Net migration outflow is expected to slow by 50% from New South Wales. As demand from the resource sector continues to decline, Western Australia, South Australia and the Northern Territory is expected to see a net outflow of people to other states and territories. Low interest rates have been a key driver of investor activity in the market. In the past year, lenders have raised interest rates and tightened their lending criteria to investors. This has caused investor demand to weaken across the board. The value of investment loans fell by 16.8%, while loans to non-first home buyers rose by 7.1%, and purchase activity from first home buyers remained steady. Increases in the stock of rental properties will mean that tight vacancy rates in most capital cities are set to ease to around or over the balanced market level of 3%. The continued strength of home prices in Sydney and Melbourne saw rental yields in these cities well below those of other capital cities. This, coupled with increased taxes and more limited availability of credit for overseas investors, will reduce overall investor demand, especially in the new unit segment. New dwelling commencements peaked in 2016, but many of these are still under construction. As this new stock comes onto the market over the next 3 years, all capital cities except Sydney will move into a housing stock surplus. Increasing supply and a slowing in demand is expected to soften most markets from late 2016 through to early 2019. House prices will be impacted less than units, which are forecast to decline in value in all capital cities. Some regional cities will, however, continue to see increases in both unit and house prices. The reduction in property prices will improve housing affordability, and as demand from investors declines, it will create opportunities for owner-occupiers, including first-home buyers, to enter the market. Over the coming decades, Australia's population is forecast to continue to experience significant growth. Meeting the long-term demand for housing with the limited availability of land in most of our capital cities will remain a significant challenge for state and territory governments and underpin long-term property prices.